Good evening, everybody. My name is Michael or Kubera, and today we can see Bitcoin is at $6,100 here. It is March 28th, and today we are discussing derivatives. So this is the future of crypto futures. We're going to get into a discussion of why derivatives are the future of crypto. Some people don't really like it because it's essentially the forex of the crypto world. A lot of people will lose money on it, and we're going to discuss that in other videos this week. So not only have unemployment claims gone on, but the economy is collapsing and the virus is infecting a lot of people, but derivatives are hot right now. And this makes me wonder why. I want to look into it. I wonder why these people are investing, even though up to 96% of these individuals will lose money. So only 4% of people will make money from that. And that's why we're going to look into it. So I've got some articles later coming up this week. We're finally in the new apartment. That's why I haven't been uploading the past few days. We've been moving. It's been super stressful. I'm not going to discuss that on this channel. So let's roll the intro and let's get right into it. We have a crypto heat map right here. Bitcoin 6,081, Ethereum $126, Ripple is at 17 cents, Tether is at $1. Woo! Big surprise there. EOS at $2, BCH 203. Most are red, and it is a tough time. March is coming to an end. It's March 28th. It has been one of the worst months in history in recent times for economic activity, for governments, for companies, for job loss, for unemployment, for crisis. Basically, everybody was not prepared for this virus. This is crazy. So last week there was reports from Goldman Sachs and a few others on Wall Street who were predicting that there was going to be 2 million individuals who were going to file for unemployment, which was record-breaking. They were wrong. And some predicted that it was going to be higher than 2 million. Many were predicting between 1 million and 2 million, which was already record-breaking. This is over 3,300,000. You can see that chart right there. It is crazy. 2008, 2009, you see right here, there's a lot of people, that's over 500,000 individuals filing right there. But the week ending March 21st, 3,300,000. That is just record breaking. So that's like 1% of America lost their jobs right there. 1% of America, literally. There's 330 million Americans, and sure, there's a lot of kids and elderly who are retired, but that's a lot of people who lost their jobs. And we're talking about a lot of individuals who did not have contracts, who were just working week to week, paying their bills, and they're the ones who are the most affected because they do not have money saved up right now, and it is going to be a tough next few weeks or months for them. And some of these guys don't have money, they don't have health insurance, some of them will get infected or their families will get infected, and they're going to get into debt, and it's just a disaster. It's just horrible from every single perspective you can look for. The companies, the governments, the individuals, whether you're rich or poor, you're going to get affected by this one way or another. Some are going to get affected more. Oil prices are just going crazy, but we're not even going to mention that. Dow Jones is at 21,600, so it did recover a little bit. As you can see, for the past 5 days, it's been green, but generally it's down from 29,000. A lot of people are saying that it's going to go right back down to where it was, 18,000, probably 17,000. We're going to see what happens. This might be just false hope because the virus is not going away. There's 645,000 plus confirmed cases with 30,000 deaths, 116,000 of which are coming from the US of A. And New York City is a huge hotspot right now. It has almost more cases than China. The whole country of China and Italy. You've been hearing about constantly. Well, New York, boom, and New Jersey. That's just a lot. That's over 63,000 right there from those two states. And we're going to see the amount of deaths go up. So obviously people are going to be panicked. Hospitals are going to be overwhelmed. These are tough freaking times. Market cap for all cryptocurrencies is $172 billion. What I wanted to talk about is CoinMarketCap also released its derivatives section right here. This was this month. Out of all the months they did it. And if you scroll down, we have Dogecoin at the bottom. So yeah, there's 34 coins right here. And most of them are through Binance. We see FTX as these random ones. Here we got OKX, we have Base FEX, And then Litecoin and Bitcoin and all of these are quite popular. We have BitMEX, Bybit, OKX, FTX, Deribit, BTSE, Kraken, Bitfinex. So quite a few players right there, with Binance taking the largest volume, 34.21%, with a 24-hour volume of $1.9 billion nearly with Bitcoin. So you have billions of dollars on derivatives during one of the most volatile periods in economic history. This isn't just about cryptocurrency, because cryptocurrency, well, it's been all over the place. The market cap has fallen from 300 billion to 150 billion, and there we go. There's 300 billion. Here's 144 billion. Now it's at 175 billion, but crypto hasn't felt the full effects of this crash as much as others have. Yeah, oil has dropped just crazy amounts. That's why the gas prices are so low. But people don't care. Here's another surprising reason why crypto prices fell, and this is also a reason why in recent times it went up. Derivatives. And our main article for today is going to be futures are pulling cryptocurrencies out of the dark. This one's from a while ago, from October 31st, 2019, but it's a good article. It's a Bloomberg opinion article. We remember 2019 as the year when the path to a peaceful coexistence with established markets became clear. Now, this article is going to go into why the forex of crypto is actually going to help institutional investors get excited about Bitcoin and cryptocurrencies, and why during rough moments people are investing into it. The traditional market's recent sell-off drove crypto prices down, but the way it did so was more complicated than even many of the most sophisticated players in crypto were able to grasp. That's because crypto's drop was staged in the derivatives market. In just 48 hours from March 7th to March 9th, Bitcoin fell 17% from $9,215 to a fresh 2-month low of $7,628. As the S&P 500 tumbled 7% Monday, traders took to selling, not buying, crypto to deal with their own cash shortfalls. The crypto industry is reacting to the traditional market dump. The effects of traditional markets on crypto befuddled many crypto stakeholders. Brian Armstrong, CEO of Coinbase, said, "Surprised we're seeing the Bitcoin price fall in this environment. Would have expected the opposite." So what Armstrong and other long-view crypto holders perhaps don't realize is the impact derivatives trading has on thin or low liquidity markets like cryptos. Selling pressure in cryptos can create a cascading effect that is hard to recover from. Traders on derivatives exchanges like BitMEX and Deribit must contend with auto liquidation. We had a fair amount of that. Such a margin call-like event happens after there is intense spot market selling of cryptocurrencies for much-needed USD on exchanges like Coinbase. As people lose discretionary income and short-term liabilities get called in, all risky assets are correlated on the Dow swing for the short term, and that includes both traditional markets as well as cryptos. Kevin Zhao, here's some long liquidations, here's some short liquidations on March 7th, so you can see some. And now the main article. People have a love-hate relationship with the futures markets. Futures are either financial drivers of rapid economic growth, turbocharging small amounts of capital to outflank entrenched barriers to innovation, or to a populace, they're demonic pits where speculators manipulate prices and corrupt honest real economic activity. Since people also love or hate crypto, the rise of BTC futures trading in 2019 is controversy squared. Looking past overheated rhetoric, Bitcoin futures exemplify the maturing of crypto markets. Futures trading has grown from almost nothing to about 50% of spot trading, according to data from 13 top exchanges. That is a huge statistic right there. Nearly half of all crypto trading for futures is 50% spot trading. It has reduced both actual and implied volatility, increased liquidity, broadened the investor base, improved portfolio management, and soothed regulatory concerns. We'll remember 2019 as the year the path to peaceful coexistence between crypto and established markets became clear. Before going further, it's important to remember that the promise of crypto is in the real code base and real networks being built to support real activity. So blockchain is just slow, technical, and boring. What matters is how people use crypto and how that changes their lives. Crypto can be successful without rising coin prices or even with no exchange of crypto for traditional currencies at any price. On the other hand, if crypto fails to deliver on its technical promises, then the coins are likely worthless. So all the drama of how many dollars people pay for Bitcoin or what regulators think is a sideshow. So here's where it gets juicy. To the disruptive innovation crypto promises. There are two dimensions to the rise of crypto futures. The first is that in 2019, all the major crypto exchanges are offering futures trading along with crypto borrowing and lending. It's now easy for any crypto owner to earn interest, usually around 10%. Very attractive for inflation-proof currencies on their holdings, as well as to make leveraged bets for or against crypto for future delivery. So I was actually thinking about this back in the day. If I had crypto, yeah, you can make a fair amount lending, and on a major exchange, it's probably safe unless you have a larger amount. But some exchanges are known, like Binance, for giving the money back. They had to take it out of their crisis fund, which they were prepared for, and it did take a while to come back, but hey, they were able to do it. Same with Kraken. And sure, there's been a lot of hate for hacks and stuff like that, but a major exchange isn't going to lose all of its customers because of a bad reputation because they didn't want to, give back a few $1,000,000. They're making much, much more, and they want to keep these people inside. So they're going to protect you for the most part. So it was a fair idea to start lending. And then I lost my crypto. But the second dimension, and it wasn't through futures. I lost it because I was investing in stupid stuff, right? And I got greedy, but that's I already made videos on that. The second dimension is less dramatic. Even though I did completely something different to lose my money, I understand that I'm not the best trader, so I'm personally not going to get involved with derivatives unless I'd understand them like the back of my hand, and even then I'd be extremely wary, as you should be too. The second dimension is less dramatic. Part of the peak excitement in 2017 was the introduction of cash-settled Bitcoin futures trading on the Chicago Board Options Exchange and the Chicago Mercantile Exchange, along with physical settled futures and options on Ledger X, all Community Futures Trading Commission regulated exchanges well known to institutions. So this was huge news back in the day. People were super excited, and now it's grown to be quite a beast. Despite the slow start and the decision earlier this year for SIBO to drop their contract, regulated futures trading volume and open interest have followed Moore's Law, doubling every 18 months. True, open interest is only 0.1% of total Bitcoin supply, but even small numbers attached to exponential growth rates are worth noticing, and we're talking about billions of dollars. Talking to traders and market makers in major exchange crypto futures suggests the open interest is real money investors, individuals and institutions transacting for their own accounts for long-term exposure, rather than leveraged intermediaries making bets that might reverse tomorrow, putting in new money. At the moment, the $200 billion market capitalization of crypto probably represents only about $10 billion of real money invested. The rest is paper profits. This is one source of instability that makes crypto prices volatile. If open interest in regulated futures continues doubling, it represents a steadily increased source of money to stabilize prices. That doesn't mean it will push prices up, a point often missed by crypto enthusiasts, but it does mean whatever prices result will be more reliable. So that's huge with derivatives. There's going to be more paper money, and that's also a big one for introducing institutional investors to crypto. They're going to be much more calmer about this whole thing. A popular misconception is futures trading on the less regulated crypto exchanges is undercapitalized day traders switching from spot to futures. This does not seem to be true. Futures trading seems dominated by solidly capitalized crypto entities, miners, dealers, venture investors, issuers, lenders, businesses managing portfolio exposures. This adds a further stabilizing force. Cryptocurrencies may or may not revolutionize everything. If it does, it may or may not shower spectacular profits on investors. The rise of Bitcoin futures in 2019 suggests that if the shower occurs, it'll be more nuanced and rational than what we have seen in prior crypto boom. Fewer unexpected cases of instant riches to seemingly random individuals, more moderate additions to average portfolio returns of millions of diversified investors. Here is some info. So the exchanges that were used for this are CME Globex, Bakkt, Binance, Bitfinex, YOBDM, Kraken, FTX, Bits, Deribit, CoinFlex, Bybit, OKX, and BitMEX. We had a mini repeat of history in September when ICE introduced physical settled futures, a price run-up in anticipation, and a sharp decline when volume proved disappointing. So this is just an opinion piece by a Bloomberg author. However, there's going to be a lot more articles that we're going to discuss about how derivatives have really, really changed the way some people view cryptocurrencies as a whole. They are risky. You can easily lose your money, but it does signify something a little bit more stable for crypto. And even if you're not involved in derivatives, they do affect the prices. Like it or not, it is going to continue to grow given the amount of traffic that we've seen even during this month, when in reality it should be going the other way. But there's a lot of people who like to gamble. There's a lot of people who like to smoke. They don't care about the warnings. They're going to ignore it. They're going to continue. So the only way we can really profit off of this and have a good time with it is to capitalize on all of these people and also understand the risks. Now, some of you might be wondering why I have a Bybit affiliate link in the description below. Bybit is one of the newer platforms out there, and if you're not interested in Bybit, this is just a normal trading platform. Quant Fury, everybody's honest trading, so this is way different than the other exchanges. But if you're up for the risk, again, it's kind of like the lottery. If you're like, screw it, whatever, I have $100, I can either spend this on lottery tickets or cigarettes or alcohol or whatever other vices, this might be the platform for you. So if you're interested, you can get $90 in my affiliate link below. Thank you guys so much for watching this video. If you're interested in derivatives, this is a huge warning. Remember what I said earlier in the video, that up to 96% of individuals lose money through this. But if you want to play around with it, I do have an affiliate link down in the description below, and I'm also going to have a link to a few articles so you can familiarize yourself with this topic. If you're not interested, which is as good for your wallet as not being a smoker is for your health, I shall see you guys in the next video, hopefully tomorrow, and I wish you guys all the best. So thanks for watching. See you later. Stay safe, and hopefully you're prepared for these next few tough weeks. Wuhan.